This is Justin Pulitzer. This is my weekend review video for Sunday, July 12th, 2015. A decent amount to cover. A lot of it is going to be a little bit more macro focused because of just the state of the market at the moment. I have two boxed areas here highlighted, and I want to start off with this to just show you some similarities in the fact that you can see we kind of came up here, made a little bit of a higher high. In this instance, this was a little bit of a lower high, but the overall pattern had been shifting down, and you can see the same kind of situation here where the angle started getting a little bit more steep with some consolidation here, similar to like this here, and then we kind of really rolled over to test the channel low down here, and we have yet to do that here. However, I want to show a couple of things. You can see the stochastics in terms of the momentum here was high here, a little bit of a lower high, and now yet still a lower high here. You know, when markets transition from bullish to bearish, this is it doesn't just sort of happen overnight. In 2007, it took the better part of a half a year for this market to roll over, and I don't know if we're necessarily rolling over here, but I will note that some of the price action is starting to get a little bit weaker. What I'm thinking here is that we are getting toward the lower end here of the stochastic momentum, and you can see here that's when the most danger happens in terms of vertical price drop. And if that were to happen, I just want to take it from that sort of more macro perspective and bring us a little bit closer to time and discuss some of the levels I see as being key here. Now, a few things that are noteworthy to discuss with regard to the S&P as represented here by the SPY. I like to use this SPY because a lot of people, retail traders, use that, and that's primarily my audience here. So you can see I had discussed in last weekend's video about coming down to this 61.8 Fibonacci level, which I had said was around 203.94. We stopped just shy of that here. Oops, we zoomed out a bit. And we proceeded to bounce pretty violently. The one piece of data there that I had mentioned in Periscope during the week, and if you haven't seen that, I'm going to put a link to that in the description below, so please be sure to check that out, is that we have yet to take out this swing high here to take out the range for a move still higher. We made this low. The following day was down, but we didn't make a new low. The same thing with the following day. We had this gap up, sold off all day, still didn't make a new low, but yet we are kind of starting to make higher highs. However, I am very suspect in terms of plays for the upside until 208.27 is taken out. It says it's represented here with an alert of 208.28 because that's just over these highs, and that would take us over the entire week's range, and that to me would start a bit of a pattern shift for a move back up to this area to fill the gap here roughly around 209.82. And if you look in terms of the high open interest for the monthly expiration for July, which happens I believe this week, the high OI is 210 in terms of calls on the upside. It's also a very high put open interest. One thing to note is that the put open interest in the monthly here way outweigh the calls, meaning more people seem to be playing for down, either directionally or hedged, and that might mitigate some of the downward move. So I'm going to talk here first about the upward move that I would see possible, and then talk about a likely downward move. So, because this would be sort of the move I think that most people wouldn't be seeing. So this to me would be the target here for an upside move. You also have the 100-day moving average, this sort of unofficial regression line that I've drawn in here, and the 50-day moving average all as a confluence. That would set up to me as actually a good right or right out row short for some type of a pullback to retest this breakout range. If it blows through there, I wouldn't really be too inclined to fade it too quickly. The next high OI after that would be the 212, which is up around this area. I would expect somewhere between the 210 and 212 area to be a lot of resistance for the market, at least short term. If we do roll over, and I will note that the last 3 Sundays we have had fairly chunky gap downs in terms of the ES, which is the S&P futures. And the first one was about 30 handles here. We had another, actually, was this the one? Well, the first one was 30 handles. Then there was about a 20 handle the prior Sunday. And then this one is about 10. So you can see the moves in terms of the futures are not, this is the SPY, so it's not going to show the ES, the gaps, but just take my word for it. It was in the 30s, then the 20s, and now we're in the 10s. So it seems that the sensitivity to these Greek headlines are starting to dissipate a bit, as well as some of the sensitivity to the China move. So if we do wind up taking out this range, and this to me would be fairly bearish, I would think that we would be looking pretty quickly to fill up to the channel low line, which I would think would be a tremendous opportunity. You can see it held here well. I think that over here it would be almost 100% retracement of this entire move between 197.86 and the channel low here, which is currently close to 200. It's like in the 199s, close to 200 area. It might take a couple of days to get down there. I think this area would set up very well for some type of a right or right out type of a long. You'd have also finally filled in this old gap from the SPY with this big run. It's also a reference high level, and it would also be the channel low. I believe there will be some price memory. There's also a lot of sort of tails and elongation here, and I believe that this would set up for a good entry for right or right out. The IV, in terms of implied volatility, would likely be spiked exceptionally high. It would be a good idea if you want to kind of play it the chicken hawk way, to just sell some out-of-the-money puts, near-dated, of course, for an entry. So these are the levels that I see as being key coming down into here. I was just took a cursory look, like I had mentioned, of the open interest. In terms of the put side, the big OIs that are really glaring are at 205 and then down to 200 with some notable kind of buffer volume zones around 204 and 203. And that's why I think that this move down might be buffered and mitigated a little bit, as opposed to just a complete free fall, because there is a lot of open interest down there, which will sort of act as a bit of a put wall. As conversely, like I had said on the upside, I think what would fudge a lot of people is if there was a move back up to 210, that would hurt a lot of the, obviously the calls would still go out of zero, but all of those puts would zero as well. So it would not shock me to see that type of a move or this type of a move. I think it's going to be, obviously, it's sort of going to be, I think, going to be a little bit binary. It's going to be one or the other. If we do wind up being like flat here at the 205, that would also be some fudgery as well. I would see in terms of the open interest, just because that's the huge strike. Let's take a look at some of the other charts to see what might be happening here. IWM, which would be nice if it would load. Here we go. Came back down a little bit lower, stopped just shy of the retest of the breakout, and then is sort of bouncing back up to that 150-day moving average. I would say that IWM is showing a little bit of more relative weakness here, although in the bigger picture it's relatively strong. So I wouldn't be surprised to see this bounce a little bit up higher, but we are sort of kissing the backside of this prior uptrend, and this area here will likely be some resistance, particularly if the market is weak. Gap fill up here would take it to 125, so that to me would sort of be the upside target. If we were to come back down, there are some very notable areas here that would, to me, be, I guess, targets. One would be this 120.97, which was the old breakout. If you kind of go back this way on the chart, I don't really want to do that now, but between 121 and 121.41 and 120.97. Also, these lows down here, roughly around 120.28. I think that this area here would have a lot of contention, particularly with the move down. Then we're talking 119.39. That to me is the absolute must hold, or we're going to start getting a lot more weak down to the 117.37 area. Anyone who's been following me for a while knows those levels very well. I've spent a lot of time discussing that. SPY, I had discussed, had been testing the 200-day. We have yet to get down there in terms of the IWM. That area of me, like I said, that would coincide very well with this point of contention that I was discussing probably by the time it got there, and would set up for a nice right or right out entry. I think a lot of people would probably have their stops run just because this low was taken, and you might get a bit of a cascade down into there. And that to me would set up for a good bounce play. Qs also below this regression line here, showing a lot of relative weakness, and I'm going to talk about that in just a moment with regard to Apple and Google. But you can see well below this range and just sort of kissing off this 106.25. I've discussed in this that, but one more piece of noteworthy, we have not yet tested the 200-day moving average yet. That to me would also set up as a nice right or right out entry. There are a lot of reference areas in the 205s, 204s, and then the the 61.8, which would be 103.87. That to me would be a good right or right out type of a trade. It would be a little bit below these lows, but 61.8s are pretty powerful. There's also the gap fill down to 102.80. So somewhere in this area to me, between the 61.8 in particular and the gap fill would set up for me as a long, and I would be playing that, particularly if it also coincided with the channel. I love to see a lot of confluences in terms of moving averages and gap fills and Fibonacci's. That always sets the stage for me, and I think if you did get a snap of this 200, there could be some type of a more cascading effect down there. A lot of the weakness I think could be attributed to this Apple. I will note this though, on Wednesday here you did break the old up channel. Thursday here tried to recapture it, but failed. We had a look below range here to retest these old highs. It didn't stop on a dime. I was sort of waiting down here right for the 200, but we stopped just shy of it, which is a little bit frustrating. And then the next day we had a lot of relative strength in Apple in terms of price action. But look where it stopped. It stopped it was sort of like the breakdown out of the channel, and then this is the check back into it. So I think Apple has a lot to prove here. You could see it's sort of below the secondary trend, which is also a bit of an unofficial regression channel. It's been a lot of resistance. You also, coming back up into the 127s, have a lot of resistance up in the, with the 50 and 100-day moving averages, which had held it so well here. So there might be some type of a recheck back. For me, the ideal scenario would be a continue down lower, maybe down to like the 115s ahead of earnings, for what everyone knows that I affectionately refer to as the shake and bake setup. For those of you who are not familiar with that, it just means that you shake out the weak hands and then bake it back to the upside. It's a bit of a homage to Talladega Nights, the movie. Anyone who watches me long enough knows I quote a lot of movies and, on occasion, some rap music. Anyhow, that is what I'm thinking with regard to Apple. If this does wind up rallying strong into their earnings, it might shed up for a bit of a shake and bake to the other side where it could be a short. But we'll discuss that as we get a little bit closer, and I'll tell you about some trades I might be putting on with regard to Apple before the print. Google, a lot of just chop in this range. I've been wanting to kind of get bullish on Google just because it's done nothing for a while, and a lot of people say that the chart in Google is broken, and yeah, I guess it is, but I don't necessarily know if the company is broken. If anything, they're earning more, and the more time it spends going sideways, the cheaper and cheaper their price to earnings ratio gets. I think a lot of the weakness, though, that is in Google is attributed to Facebook, and I believe that's because they are starting to take market share with regard to online video advertising. And just a percentage that had been going to Google is now being divvied up a little bit more to Facebook. Facebook is also a little bit of a sexier, shinier, newer model of Google with regard to their revenue growth. They have accelerated revenue growth, and Google is sort of their rate of change. Everyone always focuses on the headline, but the rate of change in terms of revenue growth is accelerating faster for Facebook than it is for Google. I know that's a very hard concept for people to talk about. You'll never hear the TV talking heads discuss that because they wouldn't know. These people, most of them have never touched real money in terms of managing, and it's not really something that would really make it to network primetime. But for me, it is what matters. And the longer that Facebook keeps stealing shares, probably the more Google will be in the doldrums. We are going to get a earnings report soon. I believe that Google also has a tendency not to move always so fast on their earnings report. Sometimes the move is flat by the open and then gives you an opportunity to get in, and you could play it against the first 15-minute range. That's sort of what I'm thinking about doing with Google. I would be interested in buying this on some type of a washout, back down to retest these lows for a right or right out type of a play. Or I would be, believe it or not, more interested if this thing was like a gap and go, if we can take out over these previous highs of the 580 and then take out this, you could see, you can't really see it here, but take my word for it, we've been in a bit of a down channel for a while. I'm going to try and show it to you here. Yeah, you can see we're in a down channel, and I would believe that if we can take out the 580, these reference highs and this 580, you'd probably see a move back into the 600s to probably retest the upper part of this range around 615 fairly quickly. If you want to play this, defined, I guess, risk trades, I would say with maybe call spreads would be safer than with common. But, you kind of want to see this snap. You want to see these high. You want to start seeing the pattern of higher lows and higher highs. And if you're aggressive, I think you can take it over the 565 here. I am a little bit leery if it does rally up into the earnings because it would take out some shorts and some potential buyers, but it would probably be a bit healthier for Google. I did discuss Facebook. I said that I thought they were taking share. Look, the market has been coming down. Facebook is just consolidating up above its old all-time highs here in the 85s. Look, again, testing back above the channel. I believe the stock is going to 100. I have a lot of people who've doubted this. I just see it happening. The stock, the longer it goes, the more earnings it generates, the cheaper the multiple gets, and it starts, if they are taking share, like I said, from Google, if they're growing their revenues faster than Google, it becomes a lot less expensive than it looks. My one caveat here is that we are a little bit extended on the stochastics. You have earnings coming up, and you have Eurozone issues. If the dollar gets stronger, if you get a weaker euro, that has been what's kind of torpedoed this the last couple of earnings. Just be a little bit careful if it rallies too hard into the print. The risk-reward setup then wouldn't be as favorable. I would like it if it does consolidate or even drift a little bit lower, still shake out still more of the weak chaser hands who were puking it here and now had to own it here. I would be looking to buy it on the closer to maybe sell some puts if it retests this breakout point here in the 50% fib, somewhere between there, 81.61 and 83.10. I believe selling out of the money puts at or below those strikes will be a easy sort of easier proxy long than holding the stock here, at least at the moment. Let's go back. I'm sorry I jumped into this. It just kind of flowed a little bit more with what I was discussing. So let's go back to VIX for a minute, or I should say, let's go to VIX for a minute. I had noted here that we were seeing a slightly higher low. We have now taken and held the 200-day moving average. You can see any moves over that in the past have been unsustainable, and we are holding there. Anything above the 200-day, to me, is still bullish for VIX, meaning that we could just write these levels down. Between 20 and 22 is the upper end of volatility. Between 22 and 25 is getting to be really the caution zone. Anything above 25 puts crash into play. We did have one momentary spike up here above 31, and that was because of the Ebola scare. So it took something like that could have been more of a big macro risk to scare the bejesus out of people, so to speak, to get that IV up. I would not be surprised if we get a move back up to between the 22 and 25 level if 20 can be taken and held. One thing that I would say is a little bit encouraging is that you had these two big spikes here, higher highs. Market did not confirm that with lower lows, and then you closed a bar below both of these days to me, which is pretty bearish because anyone who bought puts in here are now officially underwater. We'll see how that plays out with the opening bell on Monday. I had discussed this one. I got a few acolytes. There were some really big calls made this week by me. I think they really kind of went under the radar, and I don't really need the applause, so to speak. But I will say that this did wind up being very prescient. I had talked about getting back up to the 61.8 Fibonacci retracement here between 2040 and 21. Look where this stopped. It stopped at 2057 and then absolutely imploded here afterward. And I had discussed selling a call spread I had, and this was originally a risk reversal call spread. I had been short weekly puts down in here, owned the call spread, was starting to get a little bit frustrated, but I kind of knew that it was going to work out in the end, and I actually missed an opportunity here to resell the puts. It was probably a bit of a mistake, but whatever. The trade wound up working out well, and I closed it here. We came back down. If you can take these highs here now, then I believe you will see the 2009 crash peak of 123.15, which is really where this kind of resistance has been one more time, like the song goes, right? And it would also be the channel low. This, to me, would be an amazing opportunity to try it again short for a right or right out trade. If it breaks through here and gets higher, then I think there's something more serious going on with the economy, and we might be looking at recession. The sort of the maximum that you can give this before I would discuss the recession not being on, it would be up to 126. That would be the 61.8 Fibonacci line. It would also be the backside of an old downtrend. So between here and here sort of should be the stopping point. If it gets higher than that, I think there's going to be a lot of talk of recession and the economy being in a lot more trouble than I think we're even aware of. That actually gives me a great opportunity here to segue into the Fed a bit. Sorry if I'm jumping all over the place a little bit, but I'm just trying to go with what flows. Janet Yellen had spoken this week, and some of her the comments that were pre-reported by some of the sort of the experts, quote-unquote, pundits, made it sound to me a little bit more hawkish. But when she actually started speaking and got into her Q&A, she again started with the data dependent, and there was a line in there that I think I was the only one to catch because no one else has reported on this but me. And it was Yellen saying she wants to see inflationary data over a number of years to support rate hikes. So that would, not only would that take next September, this coming September off the table, it might take all of next year off the table in terms of Fed rate hikes. That would play in well for my lower for longer thesis. I'm not necessarily sure if you get that. I call it a little bit of a conspiracy theorist in me, but the U.S. government is borrowing so much money. We're almost up to 18 trillion. I think it's going to be 20 trillion soon, and that is the most debt that we've ever had. They've added on more debt during this president's term than all of the other presidents combined, and the interest on that will, if they raise rates, start to get very high. The big problem that Greece is going through is that their debt to GDP ratio is ginormous, meaning that any bit of money they sort of make goes to paying their credit card bills. And if we start raising our interest rates here, it's going to accelerate that process, bringing us closer to being a Greece, meaning that the amount of our GDP, that our amount of debt to GDP will start looking more and more like theirs. The one thing that Europe doesn't have going for them that we do, and I think one of the things that has held back the recovery in terms of the global economy, is high energy prices. As energy prices come down, I think that enables the Europeans not necessarily to recover fully, but it sort of slows the decline and helps them, I guess, recover somewhat. The U.S. is very lucky that we've had amazing technological advances in terms of horizontal drilling and fracking, and I think it's been a bit of a stay of execution for us with regard to our fiscal issues, and it's helped suppress the price of gasoline and crude oil back down to lows. And you can see that crude is sort of hovering around the 61.8 fib of this entire move. Really key level to hold. If we come back below here significantly, I believe we will come back down to getting, I don't know if we'll get a full retest, but we will get pretty close to the trend line down here in the, I think somewhere between 45s, 46s, however long it takes, down to the 42s. That to me would be the next stop. That will have me thinking again the recession thesis could be back on the table. That would be very not good for the stock market. However, if we do come back up here and we could get back comfortably through 54.24, I believe that the 38.2, 67.34, and then again $75 with regard to oil would be on the table. We had poor highs here. If this structure, if this all gets taken out to the upside, this will fly up to these areas. I don't want to talk about 82s just yet, but I believe that this isn't such an unlikely scenario. And I think longer over time, I don't know that this won't happen first, but I do believe that we will see those higher levels in crude. Crude will see better days, so to speak. One other call I made during this week was selling puts in the FXI down here. I was actually looking to do it this day, but it got away from me a bit and it bounced, and I kind of was upset. It kind of I thought it maybe have got away from me, but this here was an amazing opportunity. Just look at this. This is absolute vertical collapse price action, and rates, sort of slopes of a move are unsustainable when they become straight lines down. And the bounce here to me was, I guess, kind of inevitable. I will be looking. I meant to close some of those short puts on Friday. I didn't have the opportunity, but China just kind of needs to stop crashing for the U.S. to stop having to pay so much attention to it. If it just goes down and it goes down small, that would be helpful. Moves like this do get people's attention. It starts anyone who's invested there. People start wondering who's blowing up and who's in what. But one of the things that motivated me here when I saw this to sell those puts, and this is something that you guys can use in your daily trading, was BABA. You can see, not that BABA is any great shakes, but this was the day here that FXI made a new low, and look what BABA did. It didn't. It actually made a slightly higher low, and I had discussed playing long BABA against these double lows, this sort of, it's not really perfect tweezers, because this isn't, like if you had this bar that looked like this would be perfect tweezers, but it's good enough. It's a double low, and it wound up bouncing up. And I do believe BABA longer term there will be a move back up higher. I think that in September there's a big lockup, and I think they want to try and manipulate the stock higher to kind of create the demand prices as an advertising mechanism. However, look at this, really not looking great. Got a bit steeper here. You need to really see this thing start making higher lows and higher highs before you can sort of, invest in this. We do have a 200-day moving average now. It's up around 92s. Would not shock me to see a move back up into that area, 90 to 92. That's also, coincidentally, the IPO price. So I think that area between there is one potential upside target. I had mentioned before the hundreds. I really thought that this move was going to get up into 98s and 100. It only got into the 95s and then came back down. So if the setup here is either to still play long, just trailing up these stops from these lows. If you lose these lows here, these 76s, so to speak, I believe that the pre-market IPO price of $68 could potentially be on the table, and you want to just be either GTFO, meaning get the F out if you're long below these lows, or even play it short if you're so inclined. BIDU has not fared nearly as well the last couple of days. Made a new low here. On that China plunge, made a bit of a low here, but did respond back higher. It is still kind of caught in the morass of this channel. It did kind of look above. We got back up. I was looking for a short on this gap fill, which at the time would have been close to the 200-day moving average. It was also a reference level. It didn't even get that high, which really kind of pissed me off. And and unfortunately, it did do what I thought it was going to do. It just didn't get up as high as I thought. But BABA looking pretty weak. Anything below this low here, this 188.60 is probably, we're below there here, could potentially be a short. I don't really like to short after something like this. I'd rather see, I'd like to short after I see something like this, a couple of days down, multiple weeks to get back up, to use up the stochastics up higher, and then, play for the flush back down. If we are kissing the lows for earnings, I'm probably not going to play it short. I'd be more inclined, believe it or not, to play it long, just because everyone, I think, would be so bummed out that it could go lower. IBB made a higher high, just been sort of consolidating. The 50-day moving average is really what you have to play this against, either long or short in this point. You have the range here, so I would be, I've said this for a while, against the 50-day, IBB's a long, below it, it's GTFO or short. Gilead is my favorite of the biotechs. We got to the channel high, also a 1.618 Fibonacci extension. Pulling back, 50-day moving average. I would love to see this before earnings do something stupid like them puke it out and get the shake and bake to the downside. Anywhere down here between this sort of 50% and 61.8 Fibonacci retracement, so the 109s and 106s, preferably if we could, God willing, before earnings get a channel low, that to me would set up as a long entry, and it would be off to the races. Their earnings report, and this is what changed my mind about this. I had been playing this short, and then I flipped long. Their earnings report the last time, it didn't hold amazingly. It came back down and gave you even a second shot at this. But I didn't turn coat. I did turn coat that I said that it was welcome to my buy the dips list stock list, just because their numbers were phenomenal. They were, they were really good. So I think that this company, based on a PE basis, is actually, believe it or not, fairly cheap. I think they have some great franchises, and this is still on my buy the dip stock list. I'm a fan of the Gilead, right? Ambarella, I know a lot of people, I don't really trade this stock that much. This kind of blew off. It's just been muddling within this area. You had the bounce. It's just not really been that stellar. It did stop just ahead of these 61.8s. I would be interested, believe it or not, on some type of a move, maybe back down to channel or trend, or if there is some type of a more severe sell-off, I would really actually be interested in buying the stock somewhere near the break at around these 77s, or even down, down in this area, just kind of back to check back to where this fiasco all started. But this will set up. We are using up a lot of time in the stochastic, so maybe one more leg down, and then we could play for a bit of a bounce. Usually these things tend to go in threes. That was one. Maybe we see two, and then three lower, back down into these, sort of 60s or 70s, whenever that winds up taking place. A lot of people like GoPro. I'm not such a huge fan of the company. I think that the CEO has sort of got a lot of nerve coming public, freeing up all that stock ahead of time. Just really rubbed me the wrong way. Anything below 54.06 is iffy. We're up there, came back down. We got to one of those Fibonacci retracements below. I would wait to see that this be able to recapture over 54.06 and hold. Anything below there to me is a little bit iffy. We're making lower highs, lower lows, not the best pattern to be in. I know a lot of people like this. The stock will probably be a buy again sometime closer to the end of the summer, playing for Christmas. Speaking of holiday Christmas deals, this Amazon, absolutely strong, just holding up like a champ. I've said it before, I'll say it again. I think we're going to see the 484.73, which is the 61.8 fib. I just don't know if it's going to take earnings to do it. I would love for this thing to just chop sideways here a little bit longer, and maybe we'll play it long for earnings. If there is some type of a breakdown, the gap fill area or one of these fibs, I think would be the buy the dip area for Amazon. But this pattern is pretty bullish. FireEye, Janet Yellen, believe it or not, de facto upgraded all of these stocks. In her speech, she was talking on Friday about cyber being a major risk, and I think that the ones I like the best to play are FireEye and also Palo Alto. You can see we are above trend here. We came back, rechecked into this area. If there is some type of weakness on earnings, it's a gift, and I would be a BTD. The other one, this was very frustrating for me this week. I was waiting for this 50-day moving average touch. We got so close. We kind of took out this low just by a hair. It held the channel, but I was looking for a smidge more, so I kind of missed this. It's pissing me off, but whatever. I may get back. I may actually play this now long. This was sort of a pattern changer here. We're back above this breakdown. You're back above these highs here. Stock looks bullish. I think it's going to likely go higher. It's got the all of these stocks have the wind at their back in terms of the momentum. And let's try and get through a couple of more really quickly. JetBlue, bullish, higher lows, higher highs here. The only one of the airlines that I would even think about trading long, it wasn't the one mentioned. They weren't mentioned with the other big ones like Delta, United, and such, and Southwest in terms of the price fixing. I could easily see this getting up to the old highs and probably exceeding them with some type of a Fibonacci extension. Netflix, this is going to be a little bit tricky. They have the 7-for-1 split coming up on 7/14, and then the day after they report earnings on 7/15. So I kind of think that this is going to be a game of cooking eggs. You keep it, or whatever, cooking whatever, that's time sensitive. So I think long into the split and then out before the earnings, if that makes sense. So if there's some type of, maybe sell some short out of the money premium that expires ahead of then, or just kind of hold it long, and you'll probably get a little bit more of a bump on the split, and then there's a little bit more risk for earnings. To me, it still might perform. It might go higher. I think that the company's doing really well, but I would think that there could be a lot of risk considering it's moved up so much, and it's held up like a champ, but I believe in booking profits. I would definitely, at least at the very least, hedge. Let's skip Priceline for this time. We'll discuss it another time. Skip Taser for the moment. Let's go to Tesla. And this one, to me, it got a little bit sporty, so to speak. It kind of had this gap. It got up a little bit high, and now we're kind of coming back down a bit on some downgrades. I believe anything that can be sustained over 265 is bullish and puts the old all-time highs into play, which are up here at 291.42. If those can be breached, then we're talking about Fibonacci extensions up to 231.35 and 359.41. I believe that is where it is going, but I don't know that it's not going to kind of backpedal and chop a little bit. We have earnings coming up. Probably some people were looking to take some profits. If this comes back down somewhere between the 50-day moving average and maybe the 50% fib, I would be interested in buying. If you can, really the level, this 225 has been a really key breakout area. So between 225 and 231.93, that to me would be enough of a pullback that I'd be interested in playing it to the long side. I'm going to leave you on this one with United Health. Looks like an inverse head and shoulders setup here. It is above the 121.53. They do have earnings coming up, so that could be a little bit iffy, but the pattern looks like it does want to bust out to the upside. You could play this long against the 50-day moving average below there, and the trend and the sort of this wedge, this rising wedge below there, just GTFO. Like if you take out this 117, you don't want to really be involved. Anyhow, if you're not already, please follow me on Twitter. My handle is @JustinPulitzer. My YouTube channel that you are watching this on, just hit the subscribe button so you can get notifications when I post new videos. I do special edition videos in addition to the weekend videos, and also my Periscope rebroadcasts. Be sure to hit the like button if you like the video. That helps me kind of determine how you guys like it. Comments are always welcome. Let's have a great trading week, and cheers.